Singapore has raised its economic growth outlook after GDP beat expectations in 2025 with a 5% increase. Now, growth this year is now forecast at between 2 and 4%, up from the earlier range of 1 to 3%. Analysts say the new target is realistic, pointing to continued strength in electronics exports and a resilient labour market, as Beatrice Yap reports.
Manufacturing led growth last year, powered by strong demand for semiconductors and server-related products. This year is expected to be the star performer too.
We will be optimistic, especially on manufacturing and trade, especially on the external sectors, really supported by firmer electronics and non-electronics exports. I think overall, if we see the AI boom, Singapore being very an economy that is positioned quite well, to benefit from it. Essentially, the global electronics upcycle, resilient regional demand into this year will be the key underpin and pillar for Singapore's growth for 2026.
But the Trade and Industry Ministry says the outlook remains uncertain.
Downside risks include a renewed escalation in tariff actions or flare-ups in geopolitical tensions that could lead to a resurgence in economic uncertainty. An escalation in risk-off sentiments or a sudden pullback in global AI-related capital spending could also trigger sharp corrections in global financial markets.
For now, the labour market remains a bright spot. Economists expect hiring to outpace last year's gains and real wages to stay ahead of inflation, even as price pressures edge higher into 2026.
In terms of employment gains for 2025, they have exceeded what was in 2024. So actually, in terms of the job prospects, I think in particular wage growth for this year, we do expect that there will be positive real wage growth beating inflation. That despite inflation creeping a little bit higher for 2026, nevertheless, wage growth should at least match, if not exceed, the inflation levels. So I think that it's overall, a very positive story for the average Singaporean.
Looking ahead to the upcoming budget, she projects a stronger than expected surplus, supported by firmer corporate tax receipts.
Given that this is the first budgetary year in the new term of government, I do think that it will probably be a broadly balanced to a slightly more conservative budget. We could see a smaller than what transpired in FY25 in terms of the planned fiscal surplus position. But I think largely the policy focus would be two-pronged. One, of course, is to focus on what are the needs of the short term, both on the business and the household side.
She adds this could include helping firms navigate a more complex geopolitical business environment, as well as targeted support for certain groups to tackle cost of living concerns.
And on the trade front, authorities have upgraded this year's key exports forecast to an expansion of between 2 and 4%. It comes after a better-than-expected showing in 2025, with non-oil domestic exports up 4.8%. It was boosted by high gold prices as a safe haven asset, pushing shipments up 56% on year. Other factors include strong demand for AI-linked electronics and pharmaceuticals output. While analysts expect such exports to support growth, they warn that AI-related spending could eventually correct.
One risk that we see further out is that firms, tech firms, realize that their capital expenditures, meaning all that they are spending on, developing data center capacity, is going to see lower returns than previously expected. This could result in a dial back of capital expenditure commitments for 2027.
In the near term, the International Monetary Fund's upgrade of its global economic growth forecast has lifted prospects for Singapore's key trading partners. Still, analysts remain cautious of tariff uncertainties.
There are still challenges from the delayed impact from higher US tariffs globally. And with these rates remaining higher than before US President Trump's second term, this is going to put downside pressure on the demand for non-electronics exports.
And for more analysis, I'm joined by Tay Tse Hung, who is Asia analyst at the Economist Intelligence Unit. Now, Tse Hung, good to have you with us. Well, as we see, Singapore has revised its 2026 GDP outlook upwards. But what are the tailwinds you're looking out for that you think can push us up to the top of that range?
Yeah, hi, great to be here. So if we do end up near the top of the 2 to 4% range, firstly, likely because the tech cycle will stay stronger for longer. So what this means is that the electronics demand tied to the AI investment boom continues. And apart from that, investment as well. So not just in chips, but also the broader supporting ecosystem that would include precision engineering, machinery, as well as wholesale trade linked to electronics. And lastly, besides trade as well as investment, I would say policy support. So major projects, fiscal support can keep domestic demand firm, even if external growth moderates. So you include things like construction, we have our Circle Line, things like that. Yeah.
Yeah, well, you mentioned electronics and AI as very key sectors to watch out for. How sustainable do you think that trajectory is? And what do you think Thursday's budget statement will need to deliver to make sure that capital spending on the sector doesn't then taper off earlier than expected?
Yeah, I think in the near term, the outlook is still constructive, even though many people say we're in a bubble. But I think several indicators, they still suggest momentum carrying on at least into the first half of 2026 as the broader region, Taiwan, Korea, they still continue to see strong AI-linked electronics demand. So how long can it sustain? I would say at least to the first half of the year. In the second half, maybe not as certain. But so what can the budget need to do to actually deliver, right? I think three practical things. So first, lower the effective cost and the risk of investing in Singapore. So this can be through targeted support for advanced manufacturing, productivity adoption, as well as a scale-up financing for firms. The next one is to lock in ecosystem capex. So, not just one-off plant announcements, but also, you strengthen your talent pipelines, your infrastructure, as well as your supplier capabilities. And lastly, I think it's important to provide forward visibility. So clear multi-year policy signals to firms in order to help them commit, especially when the global trade policies actually distort these investment timing.
Now, we also see Singapore's wage growth is outpacing inflation for most people in 2025. But do you see things like the cost of living concerns eventually weighing on consumer spending and confidence as well?
Yeah, that's true. So both things can be true at once, right? So you can have high wage growth, but people are still concerned. So while real wages, they support spending, but the level of prices still shapes sentiment. So for example, they can postpone big ticket purchases or shift their discretionary spending. So you can already see some signs of this dynamic. So I think retail trade is expected to soften due to high prices. And there's also some shift of spending, towards overseas travel instead of domestic consumption. I mean, you can see this by all the restaurants, closing, even though people are earning more. So the fine dining, I think 10 Michelin star restaurants closed just in the last 6 months of last year. So that shows, the extent of how this is happening. However, at the same time, I would say, consumption is not totally collapsing. We still have a firm labor market and wealth effects. So the overall picture is one of a resilient but more selective consumption. So spending does hold up in aggregate, but households still remain sensitive to cost of living issues as a whole. Yeah.
Well, let's take a look at the Nordex now. Singapore's Nordex outlook has improved, but there's still downside risks, especially from US tariffs and also rising protectionism among countries. How do you see us continue to diversify our trade patterns to meet these risks?
Right. I think this really comes down to agility, right? So when tariffs rise, the firms will adjust their supply chains. And what Singapore can do is to capture the higher value segments, such as trading, logistics, especially when these global trade is being rerouted around due to the tariffs. But I think longer term diversification comes from three key moves. So first is market diversification. So going beyond the usual US-China route. So for Singapore, we look towards ASEAN the most, as well as India, the Middle East, and Europe to a lesser extent, but definitely more focus on the ASEAN market, which is massive, right? And second would be a product and capability upgrading. So, moving further up the electronics value chain, like what Korea and Taiwan have done, and pairing this with, high value services like engineering, finance, and data. So, of course, in finance, we are already one of the top markets in the world, so this actually helps us a lot. And lastly would be supply chain risk proofing. So deepening our role as a trusted hub for compliance and IP, within China plus one or within this kind of like ASEAN plus one production networks. So in this way, even if trade does become more fragmented, Singapore will still continue to capture the high value activity. Yeah.
Now, before we go with Budget 2026 just days away, what kind of fiscal position do you expect the government to take?
Right. I think with the growth, such strong growth, pretty high, right? So I think now is the time for the government to actually, produce a budget that is, perhaps not as not as large as last time, because last time you had to deal with all the cost of living issues, but for now their inflation is moderated, growth is higher, so I think they are going to perhaps be more targeted in terms of their social spending. So I think you will still see more household support, but I think more calibrated. So CDC vouchers likely to be in a smaller tranche compared to last year. More income differentiated, larger benefits for lower income households, maybe not so much for the higher income households or those staying in private property. Schemes will be more tied to essential spending, such as the USAVE and the SNCC rebates. I think that will still remain. And beyond just households, right? I think a couple of things that government will focus on. Firstly is incentives to accelerate AI adoption and productivity upgrades, especially among SMEs. There's been a lot of talk about AI, of course, and so targeted support for firms, facing the higher decarbonization costs after the carbon tax increase at the start of this year. So I think overall the fiscal stance should still remain expansionary, but definitely a clearer shift towards more targeted measures for the lower income rather than broad-based giveaways. Yeah.
Tze Hang, thank you so much for sharing your insights and those predictions as well. That was Tay Tze Hang, who is an Asia analyst at the Economist Intelligence Unit.